Hey guys, it's Jay Kirkwood with Secure Financial Management. Remember, at Secure Financial Management, we want to be your #1 financial resource. So I want to get you a quick video about some of the action you've probably seen in the markets. Particularly this week, it's been pretty volatile, been some somewhat ugly days, I guess you could say. And I want to talk to you about why this is happening and what the catalyst is. And there's really two things that I'll discuss in this brief video. Is first of all, were we kind of due for a little bit of a consolidation, a pullback? Yeah, probably, right? The market has come a long way very quickly. And if you've been invested for a while, whether it's through 401ks or working with us, you know that this is par for the course, right? At some stage, the markets will run up, they'll take a breather, there'll be some consolidation, maybe a slight correction. This is part of investing and what we have to live with if we're going to be in this space. There's always a catalyst for it though, okay? There's always a reason that it happens. And what we're looking at the moment is a move that's happened in interest rates. And it matters because of a concept called the risk-free rate of return, okay? When we talk about a risk-free rate of return, we're talking about something like the 10-year treasury, okay? And you can see here, the 10-year treasury has moved significantly. In the last month, it's up about 45%. Even just in the last week or so, it's up about 11%, all right? Those are big moves very quickly in raising rates. And the reason this can cause some concern and maybe some sell-offs in the market is that when we're looking at the valuations of individual equities or the stock market as a whole, one of the items we use in the equation to evaluate that is the risk-free rate of return, the 10-year treasury in this example. And what we say is, if we can only get 1% in a risk-free rate of return, being the treasury, it makes stocks look more attractive, okay? Because we're having to equate, well, what can I get for no risk? Not much, right? Well, then in that case, I can pay a little bit more for a stock or to invest in the stock market because there's such a disparity there, right? As rates start to move up, we have to reevaluate how much is a stock really worth? How much is the stock market really worth? Is it overvalued? My argument would be that even at 1.5%, that's not a high interest rate. It's probably not something that's high enough to derail an economic recovery because it's still cheap in the grand scheme of things, right? The long run rate on the 10-year treasury is more around 4.83%. And I mean, we just hit 1.5. So in the macro sense, in the large sense, is this enough to derail an economy and cause a stock market collapse? Unlikely, right? I mean, we never know for sure, unlikely, because I would say we're coming off a very low base to 1.5, and it's much lower than the long run rate on the 10-year treasury. However, when you go from about 1% to 1.5% on the US Treasury in a matter of a bit less than a month, is it going to cause some pause? Is it going to cause investors to be like, wait a second, let's kind of reevaluate things and take a look at things? Of course it will. And that's what you're seeing here right now. Guys, I don't want to go any more about that, but I did want to give you some insight into what we're seeing right now and what we're looking at when we're looking at our portfolio recommendations and our allocations for your account. As always, nothing that we talk about here should be considered a recommendation. If you'd like to discuss your personal financial situation, give us a call here at the office, 210-428-6250. We'd love to speak with you. See you then.